Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 307 on January 27th, 2024. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Snap Inc., the Direxion Daily Semiconductor 3X Bull ETF, and DraftKings Inc. And we discussed three new trades on Rumble Inc., Truist Financial Corporation, and Cisco Systems. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, the equity markets added another week of gains to a long list. The Dow Jones Industrial Average grew 245 points, closing at 38,109 points. The S&P 500 index gained 51 points, ending the week at 4,890 points. These are all-time highs, ladies and gentlemen. And now it's time for the topic of the week. The topic of the week this week is the danger of buying single options. Now, I recently mentioned that I've been buying single options more often, but there's some dangers that you have to be aware of. When you buy a single option, you're paying for time. There's a certain amount of time value that is built into the price of that option. The longer the distance between today and expiration, the higher the likelihood that the option can end up in the money. Therefore, there's more value to the time that's already built into the option. To put it short, the more time there is for that option to end up in the money, the more expensive the option will be. Even if you're buying a single option, you still need to be aware of your break-even point. That's the point at which you start to make a profit on the option. If you paid 50 cents for a call option with a $10 strike, your break-even point is $10.50 per share. If the stock expires at $10.25 per share, you still lose money even though the option finished in the money. That's the reason why I include break-even points in the trade analysis on the show. It matters. And one of the beauties of trading spreads is that the options that you buy and the options you sell have similar time value metrics. As time value comes out of one option, it also comes out of the other option. So that makes it less of an issue. You also have a lower break-even point because of this with spreads, and it's a lower cash outlay than you have with single options. So even though spreads can be a little more complicated at the start, I believe they are far better suited for new traders. They definitely are worth getting familiar with as you begin your option trading journey. So that's it for the topic of the week today. I also wanted to mention that I'm putting the Weekly Option chat group on hold. I want to make sure that I have the right design to give the best training and experience to its members. So I'm still offering coaching, and if you want to learn how to trade options better than you currently do, email me directly. I'd love to show you how I do what I do. Now let's get into the trade review for last week's trades. We'll start off with the covered call on Snap Inc., symbol S as in Sierra, N as in November, A as in Alpha, P as in Papa. At the time, the stock was trading for $16.42 per share. I looked at buying stock and selling the February 17 call at $1.37, hoping for a return of 11.88% in 4 weeks. Well, shares of Snap Inc. lost 26 cents, ending the week at $16.24 per share. The call option we sold lost 14 cents, leaving us with a net loss of 4 cents if we were to close the trade out immediately. Now, the stock price is still above the break-even point, which means this trade is still looking to be profitable for us here. So if we were losing money, I would definitely look to roll the call strike lower, but there isn't any need to do that just yet. So no adjustments are needed on this trade yet. Keep track of the stock price relative to that break-even point over the next few weeks and make sure that you have a plan in place for if the stock price drops lower than your break-even point. Next up, we have a credit spread. We looked at the Direxion Daily Semiconductor 3X Bull ETF, symbol S as in Sierra, O as in Oscar, X as in X-ray, L as in Lima. Now, at the time the stock was trading for $34.88 per share, I looked at selling the February 34.33 put spread at 37 cents, which could give us a maximum possible loss of 63 cents per spread. Well, shares of the SOXL ETF lost 87 cents, ending the week at $34.01 per share. The out-of-the-money put spread that we sold is still out of the money. However, the big price drop in the stock is reason enough to be on alert. We are still above our break-even point, and the spread is still out of the money, so no adjustments are required. We'd be happy if stock finished right here. Now, with 3 weeks left before expiration and the momentum seemingly pushing the stock lower, we should have a game plan together just in case we need it. Definitely keep track of this stock over the next few weeks and have a game plan in place for how you'll protect your position just in case you need it. And finally, we had the debit spread on DraftKings Inc., symbol D as in Delta, K as in Kilo, N as in November, G as in Golf. At the time, the stock was trading for $37.62 per share. I looked at buying the February 36.37 call spread for 67 cents. That could give us a maximum gain of 33 cents or a 49.25% return in 4 weeks. Well, DraftKings shares grew 86 cents this week, ending the week at $38.48 per share. The in-the-money call spread that we bought is now even more in the money. So with stock well above the break-even point, I'm feeling pretty good about this trade. If stock remains above $37 per share, we'll expect to collect that 49.25% return in 3 weeks. So no adjustments are needed on this trade either. Still, you want to keep track of all of these trades. I watch all of these trades and track them on a daily basis to see if they need an adjustment. There are some times that, I use week over week data, but sometimes I make the adjustment on a Monday or Tuesday if that's when the move happens. I want to make sure that I protect my position and protect my capital at all cost. So that's it for the trade review. All upcoming trades on this week's show have the February 16th expiration for monthly options in February. So let's dive on in. I'm looking at a covered call on Rumble Inc., symbol R as in Romeo, U as in uniform, M as in Mike. The stock ended the week at $6.04 per share, and I'm looking at buying stock and selling the February 6.5 call at 55 cents, hoping for a return of 16.72% in 3 weeks. Now you enter this trade by buying stock for $6.04 and selling the February 6.5 call at 55 cents. This trade makes the most money if stock prices finish above $6.50 per share. The break-even price on this trade is $5.49 per share. And in real terms, the stock purchase will require $604 and you'll collect $55 for selling the option. Next up, we have a credit spread on Truist Financial Corporation, symbol T as in Tango, F as in Foxtrot, C as in Charlie. The stock ended the week at $37.83 per share. I'm looking at selling the February 37 put spread at 21 cents, which could give us a maximum possible loss of 29 cents per spread. Now you enter this spread by selling the February 37 half put at $1.03 and concurrently buying the February 37 put for 82 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $37.50 per share. The break-even price on this trade is $37.29 per share, and in real terms, you'll receive $21 per spread that you sell and have $29 at risk. Our final trade on the week is going to be a debit spread on Cisco Systems, symbol C as in Charlie, S as in Sierra, C as in Charlie, O as in Oscar. Stock ended the week at $52.14 per share. I'm looking at buying the February 52 call spread for 31 cents. That could give us a maximum gain of 19 cents or a 61.29% return in 3 weeks. Now you enter this trade by buying the February 51 half call for $1.82 and concurrently selling the February 52 call at $1.51. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $52 per share. The break-even price is $51.81 per share, and in real terms, you'll pay $31 to enter the spread, and your maximum gain is $19 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for following along with me. I do want to point out one thing for this upcoming week. And this is obviously the week of January 29th. We do have a Fed interest rate announcement on Wednesday afternoon, January 31st. So keep that in mind as you are looking for trade ideas this week. Expect that day to be somewhat volatile. Even if the Fed holds, which many people are expecting them to do, there could be some volatility given the strength to the upside. There's been a lot of good, or I'll say a lot of bullish economic data in the news recently, both in our country and in other countries. So keep track of all of that. Definitely follow along and you'll get a great education on finance and trading along the way. So that's it once again for this week's show. Thanks for listening. Have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.